Welcome to this explainer. Today we're diving into a genuinely fascinating econometric study by economist Fabio de Jesus Suarez Agudelo. We are going to look under the hood of the ICOLCAP ETF to see exactly what the math is telling us about the current market. So if you've ever wondered how institutional quants view market cycles, well, let's dive into the data together and find out.
Here is our roadmap for today. First, we'll cover market cycles, then we'll break down 3 time frames, explore the overbought danger zone, uncover hidden risks and slippage, and finally, lay out a smart strategy.
All right, kicking things off with Section 1, Introduction to Market Cycles, where we compare straight lines versus waves. You know, human psychology loves a straight line, but the math tells a totally different story. This study looked at a massive sample size of 1,161 days for the ICOCAP. When you try to map a straight linear trend onto that data, it only explains about 46% of the movement. I mean, that's basically a coin toss. But if you apply a polynomial order 6 model, which is really just a sophisticated way of describing waves and curves, it captures an astonishing 94% of the market's behavior.
And this brilliantly illustrates our foundational premise today. As the research points out, this data scientifically proves that the Colombian market is strictly cyclical. It's governed by mathematical wave forces and mean reversion, absolutely not by endless upward streaks. The market breeds in and out over these multi-year periods, and right now, our job is to figure out exactly where we are in that breadth.
Moving right along to Section 2, Analyzing the 3 time frames. Let's zoom in a bit.
Take a look at this breakdown. Notice how the medium term, spanning 706 observations, was incredibly structurally sound. It had a beautiful 2.89 Sharpe ratio, meaning the return was fantastic relative to the risk being taken. It also had a positive skewness of plus 0.586, so the surprises were mostly to the upside. But wait, look at what happens in the short term of the last 180 days. The risk-reward efficiency drops down to 1.81, and our skewness flips entirely into negative territory.
The crucial takeaway here is that this negative short-term skewness of minus 0.193 is a literal mathematical warning siren. In econometrics, this completely validates that the immediate upward inertia is broken. The short-term momentum is now heavily tilted towards severe downward corrections and bearish pressure. Simply put, the wave has crested, and it's starting to break.
Which brings us right into Section 3, the overbought danger zone, or as I like to call it, the mass of gravity.
To really grasp this, we have to deeply respect the concept of mean reversion. Mean reversion dictates that gravity eventually comes for every single overextended market. Think of it like a rubber band. When prices stretch too far from their historical, central average, pulled to their absolute limit, they will inevitably snap back to the center.
When the researcher ran a probability model on a proposed reference price of $22,668, it spit out this massive number. In the long-term historical context, this gives us a 98.80% cumulative probability. Let's contextualize that on a bell curve for a second. That 98.80% means buying right now places you at the extreme absolute ceiling of the historical distribution. Statistically speaking, based on this massive sample size, there is only a tiny 1.2% chance of the price sustainably exceeding this level right now. Even in the medium term, we're sitting at 95.71%, which just confirms extreme structural overbought conditions.
The data is practically screaming at us. Entering an aggressive cash position at these levels is essentially asking to suffer a massive drawdown. You would literally be buying at the very roof of the historical bell curve, right as the asset prepares to purge these statistical excesses and revert to the mean.
Okay, Section 4, Hidden Risks and Slippage. Let's talk about the microstructure threat.
It actually gets a bit more complicated here. When crossing this economic data with market indicators, a severe microstructural distortion pops up. Right now, the active market quotes, the bid and ask spread you're seeing on your screen, are completely divorced from the true underlying net asset value, or NAV, of the ETF, which actually sits around 22,552.
And this brilliantly illustrates exactly why patience is mandatory right now. If you try to trade in this environment of price opacity and extreme opening volatility, you are flying blind. You risk severe slippage, which means you end up paying a secret hidden premium just to get your trade executed, or worse, you get trapped in a terrible execution because the spread is just so wide. The market mechanics themselves are currently broken.
Luckily, we have Section 5, the smart investment strategy. It is all about patience and precision.
Let's look at the timeline these models project. Over the next 30 days, the long-term model projects a totally necessary drop to around 19,207. The market simply has to breathe out and clear that statistical froth. However, the macroeconomic backdrop for this asset actually remains excellent. The 360-day medium and short-term models project massive bullish growth, targeting levels between 28,845 and 29,616.
So, here is your exact mathematical playbook to capture that long-term growth safely. Step 1. Do not rush. Wait for the trading volume to normalize back to its 3-month average and wait for the market quotes to realign with the true NAV. Step 2. Hold your capital until that necessary drop brings the price into the mathematical support pocket, clearly defined between 19,500 and 20,500. And Step 3. Deploy your funds, but do it in staggered steps using dollar-cost averaging.
By buying incrementally in that specific mathematical pocket, rather than just dumping all your cash in right now at the very top of the bell curve, you're doing something incredibly smart. You drastically optimize your portfolio Sharpe ratio. You protect your capital by severely reducing tail risk while still perfectly positioning yourself to capture that projected long-term upside to 29,000.
So I'll leave you with this final thought for today's explainer. We've seen exactly what the mathematical models demand. The real question is, will you let the fear of missing out dictate your trades and jump into a mathematically exhausted market? Or do you have the discipline to sit on your hands and wait for the statistics to guarantee your margin of safety